Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage-eitel.
All right. My name is Mark-eitel, and you are listening to the Mr. Mortgage Show. And friends, you are in the right place if you've got questions and you want answers about all things real estate and mortgage. I know it was another crazy week. There was a lot of data, some contradictory headlines, some confusion, some good news, some bad news. Guys, you're in the right place if you want the data, the tips, the tricks, the strategies, all the information that you need, and of course, the answers to your questions so you can make better real estate and mortgage decisions for you and your family. And if you've got questions or comments, shoot them to us. You can do that by calling or texting 855-462-7292. That's 855-462-7292. Jen, my producer, is standing by, womanning the Anytime hotline, and she'll get your questions on the air. Hey, if you prefer to shoot us an email, just go to mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page. There you'll find that email icon. Click on that, type away, hit send, and she'll read your questions on the air for you. But man, what another wild week in real estate and mortgage news, right? We saw the CPI numbers released on Wednesday, and they were cooler than expected. And I always struggle to not feel cynical when I'm reading the headlines because the data was up, right? 5% year over year, 1% month over month, 0.1% rather, month over month. And it was less than expected, but nonetheless still increasing. So the categories that they use to make up the index always baffle me. So I posted the actual chart to the Facebook page. If you want to check that out, go to mrmortgageradio.com, scroll down and hit that Facebook icon there. There's a tab that'll take you directly to the Facebook page. And guys, each week after we get off the air, all the data that I use and that I reference during the show, I try to post it to that Facebook group, and we've got some good interaction and have a lot of fun there. But check that out. Hit the Facebook link there at the mrmortgageradio.com, and you'll see that chart for yourself. I do believe uncooked beef roast was down this month. So go out there and get yourself some roast beef because I think we'll be saving some money on that. Just about everything else feels like it's up, though. And I do find it interesting. The major categories which seem to be pulling that number down are the big, I don't want to say one-time purchases, but few and far in between, like computers and used cars and things like that. Those numbers have pulled back a little bit, which is pulling back that CPI index as a whole. But it feels like the day-to-day stuff, right? The groceries, the gas, although fuel was down in the most recent report, I feel like it's on its way back up. At least in my hometown, it appears to be back on the rise as a direct result of that OPEC production cut. But nonetheless, there's some interesting data there if you want to dive into it. And the market responded overall favorably to the news because everybody's hoping that at some point we're going to reach an inflation number that satisfies the Fed and they can take their foot off the gas of rate hikes, because then the theory is that those easing rate hikes will work their way through the market. We might see some pullback in mortgage rates. I'm not so convinced that's happening anytime soon. If you're a long-time listener to the show, or even if you've caught the last few episodes, you know how I feel about the interest rate environment that we're in. And interestingly enough, I do think there's data to support that 6% interest rates seem to be the new tolerance, the new threshold for activity. And what I mean by that is, I don't know if it's been, 6 weeks ago, I guess, we did an episode called The Great Rate Head Fake. And that was as a result of the headlines that were screaming all over the internet. Interest rates hit 5% again. Well, they hit 5.99 for about 5 to 7 hours, one trading day. So I got frustrated with that because rates weren't really in the fives. They just barely touched it for a minute. Not too many people caught that rate lock. I think we were lucky enough to lock 3 people that afternoon with rates in the fives that they didn't have to pay for. But that 6% threshold, we saw a lot of activity around that. And there was data released that February's housing numbers, units sold was up, Housing prices in February were up. And my personal belief is all of that is tied to that tolerance of affordability, which is the interest rate at the moment, because we're not seeing prices come back down, not significantly and not across the board. There are some pockets of the country that were overheated and they're losing some value, but I've got other theories around why San Francisco housing prices have pulled back a bit, but we're not going to get into that on this week's show. But nonetheless, so 6% appears to be the new threshold. Each time rates pull back a bit and get us closer to 6%, and we can use some of those buy-down strategies to get rates even in the 5s, people seem to be willing to pay that price. And guys, that's the reality that we're in. Supply and demand control the cost of an item. The value of an asset is not determined by the cost of the capital used to acquire it. The cost of the capital has nothing to do with the value. Supply and demand does. And what I mean by that, right now, with the rates where they are, there's still more demand than supply in most markets. And that's what's holding prices. There's a common misconception that once interest rates started moving up, that housing prices were going to come down as a direct result, and that's not the case. I mean, I've talked to many people who waited it out last year on the advice that an increasing interest rate market was going to drive housing prices down, and we just haven't seen that. Guys, think about it like this. If you were at the computer store buying the latest, greatest gadget, and you took that gadget up to the cashier, that cashier doesn't care whether you're using a high interest rate credit card or cash. And it's interesting because credit cards are rapidly approaching 30% in this country on an average, which is mind-blowing to me. But nonetheless, that cashier doesn't care if you're paying a high interest rate credit card to buy that or if you're using cash. The cost of the capital used to acquire the asset doesn't determine the value of the asset. What determines the value of that or the cost of that gadget is, do they have a big pallet of them in the storeroom that they can't sell? Well, then they're oversupplied and they're going to go on sale. But if there's a line of people out the door wanting to buy that very same gadget, there's no sale in sight. And guys, that's what we're seeing in housing still today, with interest rates bouncing around where they are. And as I mentioned, every time they seem to dip near 6, boom, there's a big volume spike again. We just saw a headline released on CNBC.com on Wednesday that said, purchase mortgage applications up as rates pull back near 2-month lows. And that's, again, exactly what I'm talking about. So, guys, interest rate is not the most important number when you're evaluating a transaction. And we're going to go into that. We're going to answer your questions. We're going to keep diving into the data. But I want to share this. I was TikToking. Yes, I was TikToking, and I saw some Moneyball. Remember that movie Moneyball, Jen? Back from 2010 or 12 it came out. And it was interesting because they built a baseball team based on statistical data that nobody else was looking at. Everybody else was looking at the headlines, right? The vanity metrics, but nobody was looking at this real fundamental data. And that's the stuff that I think is super important when you're looking at housing as an option. So just like that movie Moneyball, we're going to dive into the data that people seem to be overlooking and help you make some better real estate mortgage decisions. But guys, you hear the music, you know what that means. That's my cue. We'll be back in a few. Sit tight. On the other side of this commercial break, we're going to dive into the data and start taking your questions. We'll be right back with more of the Mr. Mortgage Show. Have you recently gotten a mortgage approval and now you're wondering, how do you know if it's a good deal? I mean, the wrong decision can cost tens of thousands of dollars in fees and interest rate. Is any of this negotiable? Is this a good rate? Guys, it's Mark Eitel, host of the Mr. Mortgage Show, and we are happy at no cost or obligation to you to take a look at that fee sheet for you. We'll go line by line through it, and one of 3 things will happen. 1, we may congratulate you on getting an awesome deal, and then you can exhale and move forward knowing you did great. Or 2, we may be able to point out some places in that fee sheet that you can go back and renegotiate a better deal with your current lender. Or 3, and guys, this one's my favorite, we may be able to offer you even a better deal, saving you in fees or interest rate or both. Guys, there's no obligation. Just go to MrMortgageRadio.com. That's MrMortgageRadio.com. Click on that fee sheet review icon and we'll do the rest. It's Mark Eitel, NMLS 1929005.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is mark-eitel, and you are tuned into the Mr. Mortgage Show. We're super excited that you're here today. If you've got questions or comments and you want them on the air, call or text 855-462-7292. That's 855-462-7292. 7292. That is the Anytime Hotline. If you prefer to shoot your questions via email, just head on over to mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over via email. And Jen will get your questions on the air. She is back there bouncing around already. Somebody was kind enough to mention that Moneyball was starring Brad Pitt. I didn't mention Brad Pitt. I guess we've got some Brad Pitt fans out there. But yeah, that movie just reminded me of the importance of looking at the fundamental data underneath the vanity metrics. We see these crazy, wild, outrageous headlines, and then when we dig into the data, it's oftentimes a different story. So that was the Moneyball reference in the opening segment. I just happened to be scrolling through TikTok. Yes, I admit it. I was scrolling through TikTok and came across some of the better scenes from Moneyball, and that got me thinking about real estate and the fundamental value, if you will, in looking at the data, which is what I always try to do. I try not to get caught up in the headlines. So anyway, that's where I was going with that. So whoever shot us over that text regarding Brad Pitt, thank you for that. But hey, let's dive into your questions. I'm ready to kick this thing off if you are, Jen. You got questions over there? Okay, fire away.
Roger sent this text. I just lost my job, and I'm wondering if there is an equity line that doesn't require me to have a job. I'm looking, but there's not much available in my field. I could really use a cushion.
Hey, Roger. Wow. I'm sorry to hear that. And I don't know of an equity line that doesn't require fully underwritten income and credit. So, interesting situation that you're in. I'm sorry that you're going through this. You can Google no-doc-heloc and see what comes up, but I would caution you, I don't know that I would buy into anything that popped right up because I don't know of one. You know, fundamentally, the lender wants to be protected with either your ability to repay or a big equity position or both. So I'm leaning towards it's highly unlikely, but I don't want to discourage you from looking. I don't know of one. And guys, this is what I talk about all the time. If you think there's some financial hardship in your future and you think you would benefit from an equity line, go ahead and set that up now before the problem starts. And I use the reference all the time. If you're going to jump out of an airplane, you want to pack that parachute while you're still on the ground. You want to have it ready so that when you jump, you don't have any doubt that the parachute's ready to go, it's going to function, and you're going to be okay. And this is a perfect example. And I'm not saying, Roger, that you waited too long or that you knew this was coming, but clearly after the fact, the ability to get that equity line is not readily available. And as you mentioned, you certainly could use a cushion as you're out there job hunting. So I wish you the best of luck, brother. I appreciate that question. I'm sorry that you're in this circumstance, but I am personally unaware of an equity line that would not require income docs. So, but I wish you luck. You know, fun fact, in Canada, you're re-underwritten for your mortgage every 5 years. If you've got adjustable rate debt, most of the Canadian mortgages are adjustable. And I found this interesting. I was talking to a Canadian realtor, and they were sharing with me that every 5 years they are re-underwritten and then the rate resets. Man, we would not do well as a country if that was the case because of circumstances exactly like this. Oftentimes, people will dot all their I's and cross all their T's so they can qualify for a mortgage. And then in the case of the self-employed borrower, start writing everything off and show no income again or very little income, knowing that, you know, they've got the money to pay their bills and that's all they're worried about. So we definitely have luxuries in lending compared to other countries. I don't know of a luxury that would allow a HELOC without underwriting the income side of things. But I greatly appreciate that question, my man, and I wish you nothing but the best. Hey, Jen, what else do we have?
Steve sent this text. We're in the middle of buying a house. The appraisal values the house higher than we're paying. Can we increase the contract and get the seller to pay our closing costs, or is it too late? We already have a signed contract with the lower price, and the bank already has a copy of the contract.
Hey, that's a great question. And congratulations on buying undervalue, right? That's fantastic. So typically the answer to that's going to be yes. Even though the contract's already signed, even though the bank has seen it, you should be okay. And if you're not, call me because I know we can do it. You should be able to just create an addendum that increases the sales price and allocates that difference as a contribution towards your closing costs or rate buy down or third-party fees or whatever you need it to be on your side of the equation. Now, there are some caveats. I don't know how much you're increasing it by a percentage or how much you'll be getting back as a percentage of the purchase price because there are limitations based on the down payment amount and the loan type that you're using. So, it could be as little as 3%, but there are options that it could be a higher percentage of the purchase price as a seller contribution. But brilliant question and congratulations. And just think of it this way, guys. Oftentimes you'll sign a contract and you'll go through an inspection period and you'll uncover some deficiencies or some deferred maintenance and you'll renegotiate typically a lower sales price, or you may negotiate where the seller contributes some money back to you for those repairs. Or in some instances, the seller will just make the repairs. But my point in that example is that's a number that's being renegotiated after the contract's been signed and after everybody involved has already seen the number. It's no different when you're trying to increase the sales price with an addendum. You're allowed to renegotiate after the initial contract term. So anyway, brilliant question. Guys, you hear the music? You know what that means? That is my cue. We'll be back in a few. Sit tight on the other side of this break. We're going to continue with your questions and carry on with the Mr. Mortgage Show. Guys, we'll be right back after this short break. Raise your hand if you are freaked out by what's happening in the banking world. Well, no, put your hands back on the steering wheel. It's all starting to feel like a house of cards. And what about that $17 billion, yes, billion with a B, dollars worth of bondholder money that was lost in that Credit Suisse takeover? Right now, I'm hearing more and more people talk about a flight to safety, and they're looking at gold and silver and other precious metals, but also rental property. Yep, income-producing rental property is starting to become sexy again. Guys, we've got an amazing loan program called the Landlord Loan. It's an easy way to acquire rental property. If you've got good credit and the assets, we don't even look at your personal income. We look at the income produced by the property. Assuming that it supports the debt, boom, you're a landlord. Check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is mark-eitel, NMLS 1929005, and my team and I are here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are tuned into the Mr. Mortgage Show. You heard the man. If you've got questions, you can call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. Jen is standing by, womanning the hotline. She'll get your questions on the air. 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. Again, if you prefer to do that via email, just visit MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and type away, hit send, and she'll get your questions on the air. And as you're scrolling down, you'll see a lot of good stuff, guys. There's links to everything we talk about on the air. There's links to the really great Realtor Network. There's links to everything. That page is all things Mr. Mortgage. So if you've got any curiosity as to what goes on here at the Mr. Mortgage Show or the team behind the scenes, just visit MrMortgageRadio.com. We're adding more stuff to that each in every week. Guys, we're building out a YouTube channel. MrMortgageTV.com redirects to the YouTube channel. And right now, there's just the recorded versions of the show as podcast episodes that are up there. but we have the capability, and you can't see me right at the moment, but there's cameras in the studio because we're filming the show, and it's going to start to go up there as a kind of behind the scenes look at the Mr. Mortgage Show. You can find all of that, but be gentle when you see me on camera. You can find all of that at mrmortgageradio.com. There's links to everything. But anyway, let's dive into more of your questions. That's why we're here. That's my favorite part of the show. So I'm going to toss it over to Jen for another question.
Patty sent this one. We just want to publicly thank you. We closed on our home last week and your team was awesome. We couldn't be happier. You even referred us to Cindy and she was great too. Eric says he owes you a beer. Thanks for everything.
Eric, I'm coming for that beer, my man. Guys, it was a blast to work with you. Super, super cool people. I'm very, very excited. Guys, they relocated from Ohio and both school teachers, and they bought an amazing house down in Florida with a cool tiki bar back by the pool. I remember seeing those pictures, and I'm super, super excited that it worked out well for you. We were honored to be a part of your journey, and yes, Cindy is one of those rock star agents that's part of the really great agent referral network. So, man, you didn't need to do that. I appreciate it. Jen, thanks for reading that one on the air. I needed the ego boost today, but no, super excited for you. Awesome, awesome people, awesome story. And I hope that all your dreams come true in the new house and that you guys settle in. And yeah, I'm happy for you. So thank you so much for that. I appreciate it. But yeah, Eric, I'm calling you for that beer, my man, because I do want to see that cool tiki bar back by the pool. Anyway, Jen, let's keep some questions coming. What do we have?
Ashley has a question. We've been told buying a home with solar panels is difficult because money is owed on the panels. But the seller tells us there are no payments on the solar panels. The cost was added to the taxes. Is this going to be a problem?
Hey, that's an interesting question. And again, one of those things that goes unmentioned or not all the way thought through, if you will. So it can be a challenge if you're buying a property with solar panels, because despite what all those Facebook ads say, they're not for free. Nobody's buying those panels and giving them to you. What in this case it sounds like they did was they added the cost of the panels to the taxes, which I've seen. So there's annual payments made as part of the taxes, but that increases the tax number considerably. So you're going to have to qualify for that payment, including that larger tax number. The other challenge that I've seen around the solar panels is that oftentimes it's just a loan, like a second mortgage, if you will. There's a lien against the property. And if you're going to assume that payment, some people think the solar panels add a bunch of value to the property and the buyer's just going to assume that payment. If that's the case, then you need to be underwritten for that loan by the lender that issued the money against the solar panels. But then we've got to calculate that debt payment into your debt to income ratio. And I know a lot of people out there right now are yelling at the radio saying, but why would you have to do that? Because we don't have an electric bill. Because the solar, I get it, but it's a lien on the property that requires debt service, so it's treated as a second mortgage when we're underwriting the borrower. That goes into the debt to income ratio, even though in theory it's replacing the electric bill, which doesn't go into the debt to income ratio, ironically enough. So I've seen a lot of challenges. There's even some certain circumstances where the insurance can be a bit of a challenge. You want to make sure that they were put on a new roof. There's a lot that goes into solar panels. We are originally based out of Florida, although the company is now nationwide. I still run the company from our headquarters in Florida, and we saw a big influx of solar panels. So we've worked through the scenario a lot, and I mean a lot. And I'm happy to spend some time with you and help you work through it. If you need additional information, just give me a call or, just probably the easiest to do is call 855-462-7292, and we'll set a time up off the air where I can dive deep with you on that, because in theory, you can do it, but there may be some challenges, and you're going to want to look really hard at your debt-to-income ratio. Most of the time, we're seeing the sellers just pay those off at closing, even though the seller is frustrated by that because in their mind, they've added a ton of value to the property by adding the solar panels, and we're just not seeing an increase in appraisals based on solar panels. So I love the idea. In theory, I love the idea, especially me. I'm a bit of a hillbilly. I'm fascinated with off-the-grid living and any utility payment that you don't have to make. I love that idea. I don't really love how the solar panels look on the house, but there's some pretty amazing technology out there. I've seen some that look just like slate shingles. They're not the big rectangular panels that are sitting, bolted to the roof anymore. There's some pretty interesting technology evolving in that space. But long answer to a short question, maybe. You may run into a challenge, but just know that whether they are in the taxes or it's a second mortgage lien or a loan that's liened against the property, that is going to affect your debt to income ratio. And there's really, really not any way around that unless the sellers are willing to pay that off at closing, which in most instances, we're seeing that happen. So brilliant, brilliant question. I think moving forward, we're going to see more and more of that scenario with solar panels, as there are some brilliant solar panel salespeople out there. And the industry will likely adapt, but right now that's where we stand. But right now you hear the music, you know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this break. We'll be back with more of the show. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards, and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at mrmortgageradio.com. That's mrmortgageradio.com. My name is Mark-Eitel, NMLS 1929005. I host the Mr. Mortgage Show, and we are always here and happy to help. Check us out at mrmortgageradio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark-Eitel, and you are listening to the Mr. Mortgage Show. Guys, you got questions, comments, just call or text 855-462-7292. That's 855-462-7292. Jen is standing by, and she'll get your questions on the air. Call or text that number, or check out mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click on that email icon, and you can shoot your questions over that way. But man, we've had some interesting questions so far. We've covered the no-doc-heloc, myth or reality, and that last question regarding solar panels was super interesting. So guys, if you missed any of it, check out mrmortgageradio.com. Click on that podcast link. A few days from now, it'll post up there as a podcast episode, and you can listen to me until your heart's content. Share the show if you would. We would greatly appreciate you helping us spread the word. mrmortgageradio.com has all the info that you need. But guys, your questions are my favorite part of the show, so let's rip through a few. I know we've got a backlog over there. Hey, Jen, what do you have?
Pete sent this one. I've been researching some investment property loans, but I'm only finding options with a 3-year prepayment penalty. Is this normal? Do you have better options?
Wow, that's the tongue twister, right? Pete, penalty? Sorry about that. So Pete wants to know how to avoid the prepayment penalty on an investment loan. Great question, brother. You're right. A lot of the landlord loan type products that are out there have a 3-year prepayment penalty, some even a 5-year prepayment penalty. But the good news is almost all of them have buy down options to, at minimum, 1 year. Some of them you can completely buy the prepayment penalty out. So if you need help with that, we're here. We've got quite a portfolio of landlord products that are available with an interest-only component, a 40-year component, and the dreaded prepayment penalty can be bought down to zero, no prepayment penalty. So brilliant question, but you're right. A lot of them do come out of the box with a prepayment penalty built in. But we can help you work around that. I appreciate that question, Pete. Thanks, my man. Hey, Jen, do we have another question?
Garrett is asking, we currently rent a house and our landlord wants to sell it to us. It needs some work, though. Can we roll the repair costs into a mortgage?
Hey, Garrett, that's a brilliant question, my man. Easy answer, yes. Now, it's going to depend on how much the repair costs are, what they are, but yes, every loan type, conventional, FHA, VA, USDA, have a component that allows you to finance repairs. One of the more popular ones is the FHA 203K loan. You'll hear a lot of people talk about that. And, if you wanted to put Google to work and you Googled 203K, that would be a starting point to get some understanding of how it works. But we do them all the time. I'd love the opportunity to talk to you about it. But yes, that's a great question. And guys, there's opportunity in the market right now. We're seeing it. Some of the houses that aren't so pretty, that need a little bit of work, maybe there's some deferred maintenance, they're getting picked over in the market, right? The well-priced, well-cared-for homes are still selling very, very quickly. But a house that needs a new roof or needs, an updated kitchen, those type of things, you have opportunity there to, one, negotiate the price, maybe a seller contribution for a better interest rate, but maybe you can beat the price up enough that it justifies going in there and putting a little sweat equity in the property to build some equity right out of the box. I mean, you should have seen the first house I bought. Woo, gosh, that thing was ugly, but we sure cleaned it up and turned it into a pretty place. Opportunity right now might be properties that need some work. You might have some stronger negotiating power in that instance. But to answer your question, yes, there's a host of loan products out there that will allow you to roll the repair costs in. Appreciate that one. Hey, Jen, do you have another one ready?
Stella wants to know, is the FHA mortgage the best mortgage for someone with a small down payment? We can put down 5%, but not 20% for a normal loan.
Stella, what was that from, Stella? That was Seinfeld, right? Sorry, Stella. The woman who cuts my hair is Stella, and she's a rock star, so I have to throw that out there. Not knocking the Stellas, because I do need a good haircut. But anyway, brilliant question. FHA is where a lot of people go when they don't have a big down payment, but a 5% down payment in the world of lending will give you access to conventional loan programs as well. I think what you might find is a better interest rate and a lower payment with FHA when you're putting a small amount down. Now, there's a lot that goes into it. I don't know what your credit score is. I don't know what your debt to income ratio is. A lot of that is going to dictate which loan program and which interest rate you get. But to answer your question, it's not the only choice. As a matter of fact, with 3% down, there's still choices. But oftentimes it is the best choice because the FHA loan is usually a better interest rate, believe it or not. And they lowered the mortgage insurance premium component with FHA not too long ago. So we're seeing quite a difference in the monthly payment when we stack an FHA approval right next to the same person with the exact same scenario with a conventional loan. And guys, one thing that came out of the pandemic that drove me nuts was the misconception that FHA loans are difficult to close, or there's risk to the buyer, or risk to the seller, or the appraisal's not going to come in. Guys, when it comes to an FHA appraisal, or a VA for that matter, because they were miscategorized as well, it's the same calculations, it's the same comparable sales, it's the same method used to determine value. The only difference with the government, if you will, loan programs is there might be some safety issues that are noted. If you've got a staircase with no handrail And we've seen that, right? You want a real cool modern look, so you pull the handrail off the staircase. Well, guess what? That's dangerous. That's going to be called out, and you're going to have to put a handrail back up there. And it doesn't have to be pretty or expensive. It just has to meet the safety requirements. If you've got broken windows, if you've got a leaky roof, if you've got exposed wiring, those are things in the FHA or VA appraisal that might be called out. But the value itself, the difficulty in closing the transaction, the cumbersome appraisal, those are all misconceptions, guys. The FHA loan is no more difficult to originate and close than a conventional loan. And right now, with where interest rates are and people wanting to jump in the market, I think every loan program that's available needs to be evaluated. And if you're selling the house, who cares what loan program the person's using? As long as they're qualified and the transaction's going to close, you should be good to go. So anyway, I don't mean to turn this into an advocacy speech for FHA and VA loans. I just hated the fact that they got a quote-unquote bad rap during the pandemic. So if you've got any questions, please feel free to reach out, 855-462-7292. We'll set up a call. I'll answer any questions that you have. So I'm a fan, obviously a fan. I think any access to capital that provides people the opportunity to own homes and generate equity wealth for themselves makes a huge difference in their future, and we should explore all of the options. So okay, off the soapbox. What do we have, Jen? Another question?
Craig has this question. If I co-sign for my daughter and son-in-law's mortgage, how long will it be before they can refinance me off the mortgage? Thank you.
Hey, Craig, brilliant question, and I'm going to race through an answer because we're up against a break. As soon as they qualify themselves. So for whatever the reason is that you are required to co-sign to help them qualify, if it's an income piece, obviously they'll need to get their income up. If it was assets, you could do a gift instead of co-signing. But as soon as they're able to stand on their own as far as qualifying, there's not a time limit associated with a normal purchase mortgage of a primary, and no prepayment penalty is typically associated with a loan like that. So hope that helps, but yeah, it might be shorter than you think. And if you want to discuss options that don't involve you co-signing the loan, I'm happy to share some strategies with you. Just give me a call. We'll set something up off the air. But hey, guys, you hear the music. You know what that means. That is my cue. We'll be back in a few. Sit tight. On the other side of this short commercial break, we'll be back with more of the Mr. Mortgage Show. Let me tell you a little story about a man named Jed. Well, this is not a story about Jed, but it is a story about Mary. Mary is an awesome single mom who's been raising her daughter in a one-bedroom, one-bath apartment for the last 11 years. That's right, one bedroom and one bath. Hey, they've made the best of it. They've got bunk beds in there and it's worked. But her daughter's now a teenager and it's becoming a challenge, especially sharing that bathroom. She decided to jump in and become a homeowner. We got her approved with an FHA loan. That's right, I said it, FHA. Hey, if your agent's telling you FHA and VA loans are not getting accepted, you are working with the wrong agent. Contact me and I'll get you in touch with a really great agent. Hey, but back to Mary. She jumped in and she is now a proud homeowner. They have their own bedrooms, but more importantly, their own baths. They couldn't be happier. Guys, if you'd like to learn more, check out MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. Guys, thank you so much for spending a little bit of your day with us. We greatly appreciate it. We do this each week right here, same bat time, same bat station. If you've got questions or comments, you can shoot those over to Jen, my producer, who is standing by, womanning the Anytime Hotline. That number is 855-462-7292. That's 855-462-7292, or you can shoot us an email And that can be done by visiting MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click on that email icon, type away and hit send. She will read your questions on the air. And guys, if you want to know more about the team and what we do and where we do it and kind of get a peek behind the scenes, check out MrMortgageRadio.com. Everything Mr. Mortgage is located on that website. So, but I am going to throw it to Jen so we can keep your questions going because we've had some really good ones so far and I want to rip through a few more. Hey, Jen, what do we have?
Michelle sent this one. Is it true that banks will be offering 40-year mortgages soon? My brother says this will lower the payments and make it easier to qualify. Is this really happening?
No, Michelle, it's not happening. And I am so glad you brought this up because there is so much misinformation around the FHA 40-year mortgage. I even saw it on my local news this week. It's crazy. So now, is it coming in the future? Yes, most likely it's the next iteration of the FHA loan. But here's the thing. FHA just approved loan modifications to 40 years. So people who are in forbearance and they need a loan modification, they can't make their payments, they're taking those loans and pushing them out to 40-year amortization as part of a modification. So someone in distress not making their payments, they're giving them a longer period of time. Now, it has nothing to do with new mortgage purchases. There are some 40-year mortgages that are already in existence in the jumbo and super jumbo category and in the investor world. But by and large, the purchase mortgage, primary resident, FHA that everybody's talking about on the internet, it's not happening. It is right now for people in distress who are modifying their loan, going through the forbearance process, through the modification process, and FHA is pushing that out to a 40-year repayment. So, but thank you so much. I forgot to mention that. I had that on my notes because that has been running like wildfire through the news and through social media, and people are just out there getting it wrong. So thank you for that question. That was a brilliant share. Appreciate you. And I hope I was really clear with that answer because a lot of people are wrapped around the axle with this one. So anyway, Jen, what else do we have?
Margot sent us this text. I've been on the same job for 3 years, but I only work 30 hours per week. Is this enough for a mortgage? My bank said no because I'm only part-time.
Hey, Margot, that is a brilliant question. And I would have needed some more info, but you included it in your question. So typically with what we class as part-time work, is less than 40 hours. But here's the thing. If it's consistently 30 hours a week and has been for the last 2 years, you're fine. I don't care what your bank says. We can make that work. We've done it on many occasions. With what's considered part-time work, it has to be consistent, documentable for the last 2 years. You're going to be fine. Assuming everything else is there, assuming there's enough income there with just 30 hours, assuming that your credit meets the requirements, assuming that you've got the down payment. So I do want to throw those caveats out. All things being equal, the number of hours per week being 30 is not going to be your challenge with this circumstance. So I hope that helps. If you need more information, give me a call. We've done this many times, most recently for a woman who works for an insurance company, 32 hours a week. It's been like that for the last 5 years because she is the sole caregiver for her children, and that's how her schedule works. It works for all involved, and she's now the proud homeowner of a home that gives her kids a backyard to play in. And we did it with an FHA loan. So I hope that helps. If you need more information, feel free to reach out. We are always happy to answer any questions and help if we can. Hey, Jen, what else do we have?
Elliot is asking, I was going to take out a HELOC and put an addition on my home, but the rate my bank quoted was crazy. Now I think a cash-out refinance is the way to go. Is there a percentage cap on how much equity I can take out?
Hey, Elliot, brilliant question, my man. So yes, there is what we call tappable equity caps at 80% when we're doing a cash out refinance, because anything over 80% extends a higher risk factor to the lender. And, even if it was doable, you'd need mortgage insurance. So 80% is where we can run you up to with a cash out refinance. There are instances where we can go higher, but a safe rule of thumb is 80%. And you'll want to stay there or under to avoid that mortgage insurance anyway, assuming that there's enough equity for you to accomplish your goals with the renovation. And it's interesting because doing a renovation oftentimes is going to increase the value of the property, which is going to then reduce the loan to value from 80% to a lower amount because you've now increased the value of the property. So I get it. It's a bit of a catch-22, but you are not alone, my man, with this circumstance, because I've talked to 2 people this week who went to their bank for an equity line, and when they thought they were going to get a 4% interest rate and they were quoted 10, and then the other gentleman was quoted 10.25, he was like, wait a minute, it's cheaper to go get a cash out refinance, because if you take the equity line rate in this instance of 10.25 and you take the first mortgage rate, and this guy was at 4.5, and you blend the cost of the money, it's cheaper for him to do a cash out refinance and buy his rate down in the 5s. So brilliant question. I hope that helps, but 80% is probably where you're going to land with that one. So, hey, Jen, can we get another question in?
Brian sent this one. I'm looking at houses in brand new neighborhoods. The builder says if I use their mortgage company, I can get a better interest rate. Is this legit? Sounds like a scam to me.
Hey, Brian, the builder's mortgage company. Man, I could write a book about that. I could definitely write a book about that one. But no, it's not a scam. So oftentimes what will happen is the builder wants to control the transaction, right? They want to know that you're approved and that the loan is not at risk of not closing, because they've got to build the house to meet your requirements, and they want to know that you're going to close the transaction. So that's how all this started, with builders wanting to have their own mortgage company in-house. And then it became my own real estate company, my own mortgage company, because they wanted to control all parts of the transaction that generate profit. I get it. It makes sense. But oftentimes the mortgage company is making a profit. The title company that the builder uses is making a profit. The realtor that the builder's using is making a commission, and the builder's making a profit. So if he can keep all those dollars in-house, they very well may be offering you a legitimate better deal because they're capturing all of those dollars. Now, I would need to know a lot more to give you a concise answer, but it's not uncommon. And right now, builders who are carrying inventory, it's a great place to negotiate either a rate buy down with some of their profit, or using their ancillary services, mortgage and title, and getting a kitchen upgrade, or I'm really a big fan right now of beating them up a bit for a better interest rate, because if you're using their mortgage company and they're willing to contribute a nice lump sum of money to buying your rate down, we're seeing people get significant buy downs by using the in-house team. Now, guys, if you've got a builder who's willing to give you a contribution to buy the rate down, you can use anybody you want and accomplish that goal. They may allude to it's got to be their in-house approved person, but anybody can use a seller contribution to buy the rate down for you. But on the surface, I'm sure it seems a little bit, iffy, like the hands in the small of your back guiding you into this, the finance room, like the guy at the car dealer. But no, we see it oftentimes. But your mortgage guy can probably match that deal. If you want a second opinion, give us a shout, 855-462-7292. I'll be happy to look at the details and at least give you a second opinion whether you're getting a good deal or not. But hey, guys, you hear the music? You know what that means? We have wrapped up another week of the Mr. Mortgage Show. Where does the time go? Man, I had a blast. I hope you did. We will be back here next week, same time, same station, to do it all over again. If you need us during the week, check out MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, have an amazing week. We will be back here next week, same time, same station. See you then.
That's a wrap. Join Mark-eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.